So, hi everyone. Today we have with us Kumaresh. He is the Chief Investment Officer, Fixed Income of PGIM AMC. And we also have Rakesh Pillai with us. He is the Vice President, Zonal Head South for PGIM. So, they are here for an exclusive session for AssetPlus, both investors and advisors. And the session is focused on the current events in the debt markets and the future outlook. So I would like to begin. So Kumaresh has been in the asset management industry for close to 25 years now. He was previously head of fixed income at Deutsche Asset Management for about 5 years, and earlier had worked in senior roles as a credit rating analyst at Care Ratings, which is one of the popular credit rating agencies in India. So now we can go ahead and begin the session. So hi Kumaresh and Rakesh. So thank you for your time today.
Thanks, Prashant.
So during testing times such as this, both investors and advisors are eagerly looking forward to learn more about the debt market.
Is to maybe give you a very quick insight into how we see the fixed income markets, and this is more from a top-down view in terms of what is a macro like and how are things currently placed. And so, very quickly, our thoughts on this would be something like this. One is, given the current lockdown that we are seeing, which has now been almost for about 45 to 50 days, we think that the economy, while it is still trying to come out of the lockdown in some regions, in some cities, etc., overall, if you look at it today, it looks like the economy would have lost about close to 2 months of output. Now, this is pretty unprecedented for a large economy like India. And while, of course, it was also unprepared, it was also sudden. So, in that context, I think the overall impact for the economy has been severe. So, what we have seen, of course, in the last 2 months is both the Reserve Bank and the government, trying to tackle these issues. We've seen more amount of monetary easing from the Reserve Bank of India, while from the government, we've seen one round of measures that have been announced so far. Even as we speak, we continue to look forward to another round of stimulus, which I think the government will announce in the coming days. But from a fiscal point of view, I think we should expect some bit of weakening over the year, largely because of the fact that the government will now have to announce a fiscal stimulus as we go along. And secondly, also because the revenues that were expected as part of the budget will be under severe strain, largely because even as the economy comes out of this lockdown, we do not expect a V-shaped recovery. Things will take a while before they fall in place. And over this period, the loss of revenue that the government will have will also have to be made up by way of an additional borrowing. So overall, from the fiscal point of view, we do expect that the fiscal deficit numbers will widen this year. So while we started the year at 3.5%, we will probably end up somewhere in the band of 6.5% to 7%. So overall, but the good news is that again, when we look at how some of the other countries are shaping up and how they have planned the exit from the lockdown, it does appear that the countries, most of the other countries, have done a pretty good job, as they come out of it. And more importantly, when we look at the demand scenario in most of the other larger economies, it does look like demand is coming back pretty soon. And I think that is really the silver lining as far as India is concerned. So we do hope that a lot of the pent-up demand that could have accumulated in the system over the last 2 months will start to convert pretty quickly as companies and as banks and other entities swing into operation. So maybe I could stop here, having given you the background.
Sure, Kumaresh. So that was actually a pretty insightful overview. I'm sure that our audience would have received quite a bit of clarity on what has been happening of late. So I can start off with some of the questions that we've been often asked, that we have been receiving over the past couple of weeks. So the first one is with specific to the MF industry. So given the recent liquidity crisis in certain schemes, there's been a lot of speculation that this can have a cascading effect into multiple other debt products across the industry. So what are your thoughts on that? Like, what is the possibility that other schemes might also face these liquidity concerns in case redemption pressures increases?
Sure. What we have seen over the last 2 weeks is specifically pertaining to a category of funds, which is the credit funds. We have seen some pressure. We have seen some outflows happening in the credit funds. And specifically, this started happening on the 23rd of April. Post the announcements by one of the other funds, deciding to wind down a couple of their schemes. But if we look at how the data pans out over the last 2 weeks, one thing is clear that if you look at the credit funds, for instance, yes, credit funds have lost some AUM. So from roughly about 45 to 47,000 crores of AUM just before this 23rd April. They have lost about a third of their total assets. So currently, the credit risk funds for mutual funds stand at roughly about 32 to 33,000. So we've seen a 33% loss there. But if you look at most other categories of funds, there is no perceptible loss of AUM at all. So there is a low duration category where, again, we've seen about a 10% loss. But if you look at other categories, let's say like the short-term segment like liquid funds or the ultra-short-term funds, money market funds, and even the duration segment, we've seen, I would say, very, very negligible movements. In fact, some categories like the banking PSU have actually seen inflows during this period. So this leads us to believe that this what we are seeing was restricted to a particular category, given some nervousness from investors with this category of funds. And again, within that, of course, one also needs to look at the distribution of what the outflows were fund wise. So having said that, so we think we don't see this really spreading to the other categories. Also, one needs to be mindful of the fact that the credit risk funds as a share of the overall fixed income AUM was just about 5 to 6%. So they were not a very, very large segment of the overall AUM. Yes, they had a reasonable share. But having said that, I would think if you look at the data for the last 3 to 4 days, we have seen the AUM, the outflows, even within the credit risk funds, beginning to taper off. So I think the peak aversion that we saw in the funds was more towards the end of April. But currently, we are seeing investors gradually begin to calm down, even within the credit risk fund.
Oh, sure, Kumaresh. So one follow-up question for this. So RBI had recently announced up to 50,000 crores of additional liquidity. So some of us felt that the banks are slightly conservative and might hesitate to lend this to the AMCs in case AMCs need this to honor their redemptions. So what are your thoughts on this? Is this 50,000 crores being put to optimal use, or maybe do you feel that routing this via the banking channel might not might make it suboptimal?
So that is a good question. So what we saw, of course, again towards end of April is when we did see outflows happening from these funds, we did see yields move up quite sharply in some of the non-AAA segment papers which were getting sold. And I think the regulators did a good job at that point of time by stepping in and announcing a liquidity line of about 50,000 crores as part of a special liquidity facility which was given to mutual funds. And banks were really asked to buy some of these papers from mutual funds so as to be able to quell some of these redemption pressures that we were seeing. But I think the good thing here is that when a measure like this is announced, and we have seen this in the past as well, the mere announcement of a line or a special liquidity line like the one that was announced was really enough, from market point of view. Because once that was done, I think the nervousness that was prevailing in the markets really came off pretty sharply. And what we saw really was that the actual usage of that facility was really very minimal. So from the numbers that we have, out of the 50,000 crores, the actual number that was utilized was barely about 2 to 3,000 crores. And the reason it was only such a small amount was used was not really because banks were unwilling to buy the securities, but I think it really so happens that when you have a backstop or when you have any kind of a liquidity relief line that comes in, I think investors nervousness really subsides dramatically. And we can see a parallel even in the crisis of 2008 2009, because at that point of time we had a similar episode after the global financial crisis when we had a massive outflows in a lot of the funds. Even at that point of time, the Reserve Bank had come out with a special liquidity line for mutual funds, and the liquidity line had hardly to be used. But the mere announcement that this line was available meant that the redemption pressures cooled off pretty dramatically. So again, if you look at how yields have performed in the last week or so, so from maybe end of April until yesterday, for instance, if you look at the non-AAA segment, mainly in the AA, AA minus, and A plus segment, for instance, the yields have really cooled off by almost about 250 to 300 basis points. And that, I think, is a pretty sharp reduction in yields. And yields have come off largely because of redemption pressures having subsided dramatically. So there is no more forced selling by mutual funds. And I think, given the fact that most credit funds, do maintain normal levels of liquidity in the fund, I think whatever little outflows that we are seeing in the funds would be easily met out of those liquidity that is available. So I don't think we are likely to see any more distress or any more forced selling from funds going forward.
Okay, great, Kumaresh. So essentially, investors need not have to worry about these current issues with the specific set of schemes overlapping into other funds as well. Correct? So
That's right.
that's the takeaway. All right, great.
That's right.
So the next question, Kumaresh, so with this is with regard to the NPAs. So it looks quite likely that the non-performing assets would increase post release of the lockdown. So how bad do you think? What is the worst case scenario for the defaults? Like, do you expect that even certain AAA rated companies might also find it quite difficult to service their payments? What are the expectations from your end on this?
So this one is a good question, because it is it's a question that impacts a larger part of the economy. So what we have done internally, for instance, within our own universe, just to understand, how things can shape up over the next few quarters and months, is that, within our own universe of banks and NBFCs that we have tried to stress test, all of these issuers, particularly the financial services entities, just to understand uh, how much of stress these entities are likely to face in the coming months. One is we all know that FY20 was any which way a year where GDP had declined. So, for instance, we closed FY20 at roughly about 4.5% GDP, which was also almost a multi-decade low as far as the growth numbers were concerned. So, a slowing economy had imposed some bit of decline on the financial sector as well as on some of the manufacturing names. But currently, I think the problem that we could have is particularly with respect to the financial services sector, where we do have this issue where borrowers are claiming moratorium. Given the fact that there has been a loss of income and revenue for them. So when we did a stress testing of the financials in our universe, we found that the credit costs, for FY21 for the issuers in our universe would increase by about 30 to 50%. And when we say credit cost, this refers to the total loss that the financial entities would have to bear on the loans that they make. So these are the final losses over the life cycle of the loan that is made to the borrower. So roughly a 1.5% credit cost would mean that if you give a 100 rupee loan, 1.5 rupees of that 100 rupee loan would not be recovered. So before the pandemic happened, these numbers were less than 1%, for our universe. At this point of time, we are seeing that number go up to about 1.3 to 1.4%. So there has been, I would say, a reasonable amount of jump. But again, I would think that these numbers, how these pan out, will depend upon how quickly the economy is able to bounce back. Like I said, if maybe post the lockdown, we do see, may not be a V, but even if we see a reasonable recovery happening in key parts of the economy, then it might so happen that some of this impact that we are seeing now could only be temporary. And maybe the financial position for a lot of the borrowers will not be as bad as we think it is currently. It, it will also depend upon the extent of stimulus that the government gives out. So, for instance, the small and medium sector enterprises, which are likely to be the worst hit, and also the retail segment in terms of retail borrowers. These are segments that are likely to see the most pain. But if the relief that is given out is reasonable, then we think that the final pain to these segments will not be as much. In terms of the corporate sector, when we look at some of the larger borrowers in the AA and AAA space, I think the good news is that most of these borrowers are reasonably well placed. One is in terms of their balance sheet, because what's happened is that if you look at the corporate side in India, the corporate down cycle was started rather in 2015-16. So we were actually nearing the end of the corporate down cycle as far as the wholesale banks were concerned. So a lot of the large corporates as well, had kind of delivered. So they had balance sheets had become much stronger as we were getting into this crisis. And as a result, I think some of the large corporates are actually much better placed at this point of time. And given the fact that they have created liquidity, raised capital, both debt and equity, I think that should keep them in good stead. So as far as bigger names are concerned, we do not foresee any major stress. Yes, one cannot rule out entirely some rating changes or downgrades really. But in terms of the final credit impact, I think that should not be too large as far as the corporates are concerned. But I think in this cycle, what we might see is a little more impact on the retail borrowers compared to the corporate borrowers.
So yeah, thanks, Kumaresh. So that was also pretty explanatory. This was a question we have been receiving from quite some advisors as well, because they were wondering what if the AAA rated securities also might be unable to service the debt. So
Okay.
this question is with regard to the government borrowing for the coming year. So
Sure.
it has been put out as 12 lakh crores. That
Yes.
additional is required to meet the stimulus and other government initiatives. Do you feel that this can have an impact on the Indian sovereign credit rating? And in case it does, how would you expect gilt funds to be affected over the short and medium term?
Sure. So I will take this question in two parts. First is in terms of the overall borrowing and how do we see that moving as we go forward. One is, when we started the financial year, so if you look at the initial borrowing numbers which the government had put out, the gross borrowing was about 7.8 lakh crores. That was in line with a fiscal deficit number of 3.5%. Now, this was as part of the budget that was presented in Feb. Today, what has happened is, as part of this crisis, even assuming that the government did not announce any stimulus, if you look at what happens to the government budget today, there is an impact in terms of the revenues. So there is going to be a loss of revenues because both direct as well as indirect tax revenues are going to take a hit in FY21. Now, direct tax revenues will take a hit because tax collections, both corporate tax as well as income tax, will be lower. Indirect tax revenues will be lower because GST collections, we do expect will be down almost about 25 to 30% for the full year. So, in addition to this, what is going to also happen is if you look at the non-tax revenues, FY21, had a very high share of revenues that were assumed from non-tax revenues, and that is mainly from disinvestment. And of which, let's say, we had one big ticket disinvestment coming from LIC, and second one from BPCL. Now, given the state of the capital markets currently, we are not entirely sure of the disinvestment numbers will go through. So, total disinvestment was roughly of the order of 2 lakh crores. So, which is why even if the government did not announce any stimulus, in FY21, purely from what we have seen right now, this 3.5% fiscal deficit number would go, in our view, to roughly about 5.5%. Now, what is a positive for the government this year? I think the biggest silver lining for the government has been fall in oil prices. Now, when we started the year, oil prices were roughly about $60. Today, oil is about $25. And we do think that oil may go a little higher from current levels as most of the global economy bounces back, etc. Maybe it goes back to $35 to $40. But despite that, the savings for the government purely from oil would be roughly of the order of 1% of GDP. So I think that is where the government saves this year. But having said that, then the net context is that even after saving on oil, the government and the additional fiscal stimulus that the government will have to do, this 12 lakh crores numbers that we are seeing right now, our sense is that this number will increase, as we close the financial year. And our sense is that this 12 lakh number would probably go somewhere between 14 to 15 lakh crores. Now, one also has to understand that this is a very unique year. It is a very different and very difficult year for the government. and which is why the borrowing numbers will really be completely off the usual trajectory that we are seeing. Now, as far as rating agencies are concerned, what actions could they take? Uh, Sovereign ratings are different from corporate ratings, in one way. In that, sovereign ratings really take a very long-term trajectory when they make any kind of rating changes. Unlike in the case of, let's say, normal corporate ratings, which see more frequent revisions, sovereign ratings normally look at a 5-year to 10-year time frame. And if you look at how sovereign ratings pan out, normally there are three key categories which rating agencies look at when they look at a sovereign. Now, the first aspect is economic fundamentals. So there they look at broadly, what is the economic fundamental of a country, by which they would look at everything which is more, I would say, long-term in nature. So, for instance, they would look at what is your tax to GDP. They would look at what is the tax buoyancy for the economy. They would look at what is the institutional framework within a country. They would look at tax laws. They would look at judiciary. They would look at institutional mechanisms. Everything. So I think all of this comes normally in the economic fundamentals that they look at. And the good news is that this is normally more than 50 to 55% of weightage for any country. The second thing they look at is fiscal ratios. And here they would look at key things like debt servicing capability. They would look at things like debt to GDP and those kinds of parameters. And that would be roughly, again, about 20 to 30% of the overall rating. And the last thing they would look at is, key events and the impact that they have in the short term. Now, the COVID pandemic, of course, would fall under that. And they would look at, what impact it is likely to have on growth. Now, for instance, GDP this year will fall dramatically. But rating agencies don't pay too much importance to GDP in a particular year. But having said that, things like debt to GDP, which is the part of the fiscal ratio, is very important because India's debt to GDP used to be about 70%. And when we say debt, this is general debt. It includes both the central government debt plus the state government debt. For countries of a similar rating that India has, that number tends to be somewhere in the band of about 45 to 60%. So we are already above, where countries in the same band are, and that 70% number for India is likely to go up by 10% this year to 80%. Even for the other countries, we do expect that the number will shoot up by between 9 to 10%. But having said that, within the peer group that we have, India still remains an outlier. We have a weak number as far as debt to GDP is concerned. So all said, we don't think that the numbers or the overall fiscal picture for India really looks very bad in relation to how it looks for the other peer group countries. The only point to be kept in mind here, of course, is that when we look at ratings, now there are three rating agencies, Moody's, Fitch, and S&P. Moody's is the only rating agency which has a higher rating for India currently. So they have India's rating at triple B plus with a negative outlook. And they have a rating at triple B with a negative outlook. And S&P and Fitch have India at triple B minus stable. So we do think that Moody's could downgrade India at some point of time, but the idea will be to probably get it more in line with what Fitch and S&P have. And a Moody's downgrade really will not matter too much because markets really normally look at the lower rating, and S&P's rating is at triple B minus, and that we don't think is likely to change. And incidentally, both S&P and Fitch have just reaffirmed India's ratings just last week. So overall, yes, we will have to monitor the trajectory in the coming years for the fiscal. But near term, I don't think ratings is such a big worry.
Okay, understood, Kumaresh. So the next question is with regard to the interest rate scenario. So currently RBI repo rates and consequently the fixed deposit and home loan rates are quite low. I think they're almost at a decade low. So what is your view on this? Do you foresee a set of further rate cuts happening in the next few quarters?
So on rates, our view is that yes, we do think rate cuts will happen. RBI did a massive one-time rate cut of 75 basis points in March, getting it down from 515 to 440. We do think that another 25 to 50 basis points of rate cut is very easily possible. And the reason rate cuts are possible over the next few quarters largely is because there is no more of an inflation worry, which is something that really plagues the central banks. And if you look at the inflation trajectory, I think we are pretty confident that inflation will continue to weaken over the next few months, largely because of two factors. One is because oil itself has collapsed, and oil is a big contributor to inflation for India. And the second point is with economic activity falling, we will also see other core inflation coming off quite sharply. So yes, I think RBI will cut rates to both stimulate growth and also to promote investment in the coming times. More important point would be to see how easily those rate cuts get passed on, because the bigger issue in India has been the transmission of rates. So while even in the past RBI has cut rates, banks have not been able to transmit rates. And this time, hopefully, given the tools that RBI has been using and with excess liquidity in the system, we think that some of those rate cuts will actually get transmitted. So over time, I think some of these rates which you mentioned, like home loan rates, etc., we should see them coming off at least over the next few quarters, or maybe next few quarters.
And what is your view on the currency, Kumaresh? Like, what are the chances of rupee weakening further from here?
So the currency is actually one of silver lining for us really, and it's standing out as a bright spot. So the one bright spot really today for India, if you look at the macro picture, is the external front, because on the external front there is little to worry at this point of time, because I think India has done good work over the last couple of years, and ever since the 2013 and 2015 period, when we had this external crisis, we have managed to correct some a large part of our external imbalance. So today, if you look at FX reserves, we are at $480 billion, and that is about at the March level of imports that we. So if you look at our end of April position, our FX reserves are about $480 billion. Now that covers our imports at about 15 months. If you look at the level of imports for March, it's about 15 months of imports, which is a reasonably good number, because at some point over the last 5 to 6 years, our number had dipped to about 6 months of imports, which was very low. But 15 months is a reasonably good number to have. The other point is on oil itself. With oil having come down or come off so sharply, the current account picture looks very encouraging. So we will actually end this year with probably a neutral to a marginally positive current account position, which is very rare for a country like India. And if you add the capital flows on top of that, we've been seeing relatively stable capital flows, and this year should be no different despite what we are going through. So we will actually have a positive BOP position. So on the whole, we are of the view that we will see FX reserves continue to increase in the months ahead, and that, in a sense, presents a very good picture as far as the external account is concerned, and it also makes it very robust. And in fact, we would be surprised if the rupee really depreciates, because our call is that given where we are, we should actually see a marginal bias for the rupee to appreciate in the months ahead.
All right. So this would be the final question, Kumaresh. So this is a little bit more investor centric. So which
Sure.
fund categories would you recommend for investors moving forward? So should investors stick to low and short duration funds, irrespective of their financial goal durations, or would this be a good time to take on credit risk given the higher yields? So what are the possible categories that investors can look at, say, for a period of 1, 2, and 3 years at this point in time?
So when we look at investment options for investors, normally we break down the fund basket into three categories. So one is we break it up into short duration products, and in the short duration we include everything starting from the savings products like the liquid fund, the overnight, ultra, the money market, and up to the short duration segment, which is up to the 3-year segment. Then we have the mid to the long end duration range, where we include funds like the medium and the medium to long end products, the gilt fund and the dynamic fund. And the third category is the accrual or the credit category. Given where we are right now in terms of the macro position, our sense is that the long end of the curve, will continue to see pressures from the issuance or the supply. Like we discussed, we already have a borrowing calendar which is roughly about 12 lakh crores, and we see an upside risk to that number. Now, what will happen this year, of course, is that we do expect that RBI will come in, RBI will step in, and they will do some buying of bonds in the secondary market because the market will not be able to absorb all the supply by itself. So that should be a positive for the market. But despite that, we think, given the kind of the strain that the government has on the fiscal, the long end portion of the curve will continue to remain pressured, which is why we would advise investors to rather remain cautious and not allocate too much to the long end portion of the curve. Although from time to time, we could have some opportunities there, but really more from a structural point of view, we would rather advise investors to avoid that segment. On the short end segment, on the other hand, we think that segment will benefit because of all the excess liquidity that we are seeing currently in the system. So even if you look at the yield curve in the 1 to 3 year segment, or even in the sub 1 year segment, the segment has already done quite well over the last 6 months, and particularly in the last 30 to 45 days post all the rate cuts and the excess liquidity that is sloshing around. And as RBI maybe cuts rates further going forward, this segment will benefit more. So we think this segment will have the least volatility going forward, and investors will not have to worry really about any M2M losses as far as the investments are concerned. So I think the short duration segment up to the 2 or 3 year segment is the sweetest spot as far as investors are concerned. On credit, I know credit has been a bad word over the last few quarters, but really I think credit is very critical. And really, if you were to see in terms of what happens to the economy, how the economy revives, I think GDP cannot pick up unless we have a pickup in credit. And very important, I think that investors do have some allocation of credit in their portfolio because credit will also give carry to the portfolio. So they need to be selective in terms of what they pick as far as credit is concerned. So carefully chosen credit fund, with I would say proper checks and balances and a proper mechanism should help investors. So I would advise both short-term products and some allocation to credit for investors.
Thank you, Kumaresh. So with this, we can wrap up the question and answer session. And I would in fact like to thank Kumaresh as well as Rakesh for your time and help in organizing this session. I'm sure the discussion was extremely informative for the audience, and it would have cleared up a lot of questions that were in their minds, especially the recent events in the past couple of weeks. Don't mind. So you, Kumaresh,
Sure.
you're part of Prudential Global Investment Managers, PGIM, which is a recent entrant in the Indian mutual fund space. Could you please provide a quick background of Prudential's expertise in asset management in India and globally, and throw some light on the processes that you follow for your debt products?
Yeah, sure. Thanks, Vishwant. First of all, thanks, for giving us this opportunity to be in front of you today and to maybe showcase our brand, to showcase our capabilities as part of Prudential, and to let you know what is it that we exactly do in terms of our business and in terms of products at PGIM India Mutual Fund. So maybe let me start essentially by telling you or giving you a background in terms of who and what we are. For some of you who may know, but for the others, maybe just to give you a background. So PGIM India Mutual Fund is a 100% owned entity of Prudential Financial Corporation US. Prudential Financial Corporation is a fixed income powerhouse and an overall asset management and an insurance powerhouse globally. They rank 10th largest in terms of the total money that they manage globally. Internationally, their overall business is spread into two main verticals, which includes asset management and insurance. Insurance is the larger business, but an asset management business is also a reasonably large business for them. They are also present into alternative asset categories, of which real estate is one of the larger interests for them. In India, Prudential has been present in multiple roles. So they came in here initially in about 2010. So they have been in India for now almost a decade. So they started out as Pramerica asset managers initially in 2009-10, and then they had a joint venture about 5 years later. And in 2019, what happened is Prudential decided to go it alone. So they acquired the 50% interest in the joint venture from the other shareholder, and have increased their stake to become a 100% shareholder in the India mutual fund business. So today, as we are, Prudential owns 100% of the Indian asset management business. This, I think, is very important for multiple reasons. More so because given where we are, both locally and globally today, as we all know, without having to get too much into it, we are probably going through a crisis that is probably once in a century kind of a crisis. And I think at this point of time, having somebody of the parentage and vintage of Prudential really counts for multiple reasons. One is given the kind of financial backing, given the kind of assets that they manage globally, I think that really keeps us in an extremely good stead. Prudential, as we know, given their large size, is an extremely committed organization. Globally, also because they are present in the insurance business, normally the timelines or the horizons that they have in any region or in any geography they go is really long term. The other thing is really for us to be able to borrow from the expertise of Prudential, because Prudential is present today in multiple geographies. So they are present, other than India, they are present, of course, in Europe. They're present in Asia. They're present in Latin America. They're present in the US and in Japan. So today, when we took a look at the crisis, I think we have extremely good insights in terms of what's happening to the business of Prudential in most of these other geographies, and also we are, I would say, better placed in trying to understand how some of these other countries, let's say like China, where Prudential is present, how they have been tackling this crisis, what's been happening to the business. And what is it that we can expect really from the economy here in terms of how the other economies are shaping up? So some of the largest businesses globally for Prudential includes countries like China, Italy, Japan. And I think all of these countries are, I would say, very, very critical at this point of time for us to be able to borrow from. So I think that is a little bit of a context as far as Prudential is concerned. The other important point also which I wanted to bring out is the fact that Prudential acquired this 100% stake in August 2019. And the timing was very important for us because 2019 was also the year when we saw a fair amount of crisis that was happening in the Indian debt markets. First of all, in late 2018, we saw the ILFS debacle. Then in June, July 2019, we had the issue of DHFL. And at that point of time, really, at the low point in the cycle, Prudential stepped in to become a 100% owner. What we have also done since then is that given all the developments that have been happening locally, Prudential, first of all, decided to put in a very robust system and a very robust mechanism for the Indian business. Well, we have been part of the Prudential system even earlier, and we did borrow significantly in terms of the expertise that they have in the fixed income markets. What we have done in the last 6 months is using both local expertise and also using the expertise of our colleagues in the US, put together a very strong mechanism really to look at how we would analyze the credits of issuers in the Indian market. Now, a lot of questions have been asked in the last few months and quarters about ratings in the Indian context, and it has largely to do with how some of the ratings have behaved, particularly in some of the key cases where we've seen ratings drop dramatically. So what we have done, of course, now is to put together a very elaborate mechanism, which is very proprietary in nature. And we have now internal rating models, which is divided into three different categories. For instance, we have a rating model for banks, we have one for NBFCs, and we have one for manufacturing companies. So what this has done for us, of course, is to reduce dependence meaningfully on external ratings. While, of course, we still look at external ratings, because they are an important input. But really, a large part of our decisioning and large part of what we do in terms of credit and investments is decided by our internal model. Also, what it does is that it gives us a little more ability to be able to price most of the credits and most of the papers that we buy into the portfolio more appropriately because it is a direct understanding of how we think that risk is likely to perform in future. So I think this is something that I wanted to bring out. Also, what the system has done for us is that while we used to operate with a universe of names earlier, which used to be about 250 odd names, the new mechanism that we have now put in place has led to the universe coming down almost by a third. So currently, our fixed income universe would be roughly about 170 to 180 names. And what we have done is this system has also helped us to take off, some of the marginal names which we think could come under pressure, particularly in light of the recent developments in the last year or so, and also in terms of what the economy is currently going through. So I think this is something that I thought investors and our partners would be happy to know, as they invest with us.